You can use RISP 500 to do two major things. First, protect your stocks from big losses. Second, exploit each risk level with best assets to maximize returns. Or do both at the same time. Let's start from the first. To protect your stock portfolio is very simple. All you need to do is first select a RPT level, which I will explain in just a minute. And every day follow the RISP 500 risk measurements. If RISP 500 percentile rank is greater than your RPT, it means the risk is too high for you, so you should immediately take protective actions. But if the RISP 500 percentile rank is lower than your RPT, it means the risk measured is within your risk tolerance level. That's how you can easily use the daily RISP 500 to protect your stock portfolio. Now, what is RPT? It stands for Risk Percentile Threshold. In simple terms, RPT is your maximum risk tolerance level. For example, if your RPT is 85%, you won't take up risks higher than the 15% highest risks ever measured by RISP 500. A conservative investor should use a lower RPT like 70% or 60% or even lower. An aggressive investor can use a higher RPT like 90% or 95% or even higher. A moderate investor may choose a RPT like 80% or 85%. But the key is that no one size fits all. Each investor should choose their own RPT and make adjustments over time if necessary. How is the RISP 500 calculated, you might ask? Well, RISP 500 is calculated after our proprietary algorithm crunched data from multiple sources. It tracks 15 plus variables. The majority of the variables comes from the volatility markets. Why? Volatility markets are extremely sensitive to even the minuscule changes in stock prices. Thus, they respond the fastest among all relevant variables to risk perception changes. To be a good risk indicator, RISP 500 must react fast too. It's absolutely key that we have an accurate picture of the situation quickly and early on. Finally, let's talk about how you can use RISP 500 to exploit each risk level for max potential gain. You select assets that tend to perform best at each level of risk. You match assets with risk levels. The logic is simple. When risks are too high, you should hold the safest assets, which can be cash, bonds, or gold, depending on the circumstances, of course. When risks are lower, you may hold assets that are riskier to seek a better return. And when risks are extremely low, you can be even bolder. You may hold riskier assets with greater return potential and even use leverage if you want. This can only be done if you have a risk measurement tool like the RISP 500 to guide you.